You're tuning into The Deep Dive. And today we're tackling something I know a lot of you have been wondering about, especially with all the market swings lately. The big question. With the S&P 500 now trading below that level it was at before the tariff talk really heated up, around 5,670, is it actually time to buy?
Exactly. It's a really timely question. And to help figure this out, we've been digging into a recent Motley Fool article. It's titled, Should You Buy the S&P 500 Index Below 5,670?
Right.
So our mission today, basically, is to pull out the key insights from that piece, try to make sense of the current situation and see what it might mean for, your investment thoughts.
Okay, so let's set the scene. Where did this particular chapter start?
The article reminds us that, before President Trump's announcement about steeper tariffs, the S&P 500 was, kind of cruising along near that 5,670 mark.
Yeah, it was relatively stable there for a bit. But what's interesting, and what the article really details, is how fast things change. The market reaction was pretty much immediate.
Well, we saw some pretty wild swings. The S&P 500 actually dipped all the way down near 4,835 at one point.
Wow, that's quite a drop.
It is. And even more recently, it's been sort of bouncing around maybe closer to 5,400. Still a lot of movement compared to where it was.
Definitely. And it wasn't just the idea of tariffs making investors nervous, was it? The article points out there were other things kind of bubbling under the surface already.
That's a really important point, actually. The article mentions stuff like China's DeepSeek emerging in the AI space. That got people thinking, maybe questioning some of those really high valuations for the big AI companies.
Ah, okay. So some tech worries.
Yeah, exactly. And on top of that, we were starting to see some economic data that, it hinted things might be slowing down a bit, a potential cooling off.
Okay, so the ground was already a little shaky, maybe. And then the tariff news hit harder.
Right. The initial tariffs had already spooked people a bit, But then came the talk of even steeper tariffs, and on more countries, China, Cambodia, Vietnam, the EU.
That sounds like it would definitely escalate concerns.
Oh, absolutely. And the article notes that strategists, economists, they were understandably getting worried. They started talking about the potential for stunted economic growth.
Like hitting the brakes on the economy.
Yeah, or even worse. Some were raising the possibility of a U.S. recession because of the combined effect of these tariffs and, companies having to suddenly rethink their whole supply chains. Big disruptions.
That makes sense. And what about the bond market? How did that react to all this uncertainty? The article mentioned that too, right?
It did, yeah. And it was interesting. Initially, the yield on the 10-year U.S. Treasury note, it actually went down.
Okay, which kind of fits with fear, right? People moving to safety.
Exactly, that classic flight to safety idea. Money moving out of stocks, maybe into bonds, pushing bond prices up and yields down. But then it reversed. The yield actually went up later.
Huh. That seems a bit counterintuitive with all the worry. Why would yields go up?
Well, it's complex, right? It could signal different things, maybe concerns about inflation down the line because of tariffs, or perhaps the market was reassessing the actual economic impact, maybe not quite as bad as initially feared, or maybe other factors were coming into play. It just shows how many signals the market is trying to process at once.
Okay, got it. So, lots of turmoil. But then there was a twist, wasn't there? That announcement on April 9th. A pause.
Yes, exactly. A 90-day pause on most of those higher tariffs. And the market reaction to that was pretty dramatic.
How dramatic?
The article describes it as the stock market really taking off. The Dow Jones shot up almost 3,000 points.
Wow.
And the S&P 500, it surged over 9.5%. That was, believe it or not, its third best trading day since World War II.
Good grief.
Yeah.
That's huge. Shows how much tension it built up, I guess.
Absolutely. A massive relief rally, basically.
And the reason given for the pause. The article mentions President Trump said it was because countries were reaching out, wanting to negotiate trade deals.
That was the stated reason, yes. Countries reaching out. So that pause definitely gave the markets a breather, suggested maybe, a step back from the brink.
But there's always a but, isn't there?
Well, yeah. It's crucial to understand the exceptions here. The article is very clear. Those high tariffs on China, they stayed. In fact, some were even increased. According to a White House fact sheet mentioned in the article, they could potentially hit like 245%.
Okay, so the pause wasn't universal. The main friction point with China was still very much there. Maybe even worse.
Precisely. So, yeah, some relief, but that big cloud of uncertainty around U.S.-China trade, it definitely didn't just disappear. It's still hanging there.
Right. And if we look beyond just the tariffs, The article also reminds us that the economy wasn't exactly perfect before this latest round of tariff news, correct?
That's right. There were already signs of, let's say, deterioration. U.S. consumer sentiment, for example, had already started to dip.
People were feeling less confident.
Seems so. And economists had actually started tweaking their U.S. GDP growth forecasts downwards, specifically citing the impact of those initial tariffs even before the steeper ones were announced.
So the foundation was maybe already a bit softer. And we need to remember, even with this 90-day pause, a lot of tariffs are still active.
Right.
We didn't just reset to zero.
Absolutely not. That's a key takeaway from the article. Those 25% tariffs on steel, aluminum, automobiles, they're still in place. And there's still that sort of base 10% tariff on imports from pretty much all countries during this pause period.
So the economic drag from tariffs hasn't gone away. It's just maybe not getting worse for most places for 90 days.
That's a good way to put it, yeah. The impact is still there.
Okay, let's shift gears a bit to valuation. The S&P 500 is below 5,670. Does that automatically mean it's, cheap? A bargain. The article uses that Shiller CAPE ratio to look at this, right?
It does, and this is really fascinating. The article suggests that, well, even below 5,670, the S&P 500 isn't necessarily a steal. So, the Shiller CAPE ratio, basically it looks at stock prices compared to average earnings over the past 10 years, adjusted for inflation. It tries to smooth out the short-term bumps.
Okay, a longer-term view of value.
Exactly. And based on that longer-term view, the article says the market, even at these levels, still looks relatively expensive compared to, say, most of the period since the year 2000. Not historically cheap.
Right. And that connects back to what you said earlier about those AI stocks, doesn't it? Even before the tariff drama, some parts of the market were looking pretty pricey.
Precisely. The article flags that the high valuations of some of those big tech and AI names were already contributing to the overall index level being, well, elevated.
So the headline might be S&P is down, but the underlying story is that it wasn't exactly cheap to begin with, especially in those hot sectors. We're not necessarily in bargain territory just because the index dropped off that specific high point.
Exactly. That's really important context. The overall level is one thing, but the underlying valuations, particularly in certain growth areas, were already stretched. Definitely something to keep in mind if you're thinking about buying.
Okay, so pulling all these threads together, what's the final verdict from the Motley Fool article? Should people be jumping in to buy the S&P 500 below 5,607?
Well, the main thrust of the article is basically expect more bumps in the road. Yes, the 90-day pause calmed things for a moment, but those underlying economic concerns we talked about, they haven't vanished.
And the market isn't exactly on sale.
And the market doesn't look historically cheap based on metrics like the Shiller CAPE ratio, so continued volatility seems likely.
But it's not all doom and gloom, is it? The article does mention the long game.
Oh, absolutely. That's crucial. History shows that over the long term, investing in the broad market like the S&P 500 has generally worked out well. That perspective is important.
But maybe don't back up the truck just yet.
Right. The article cautions against getting overly aggressive right now. I think the phrase used was something like, not the time to be a hero.
Okay, so if you are thinking about investing now, what's the suggested approach given all this uncertainty?
The recommendation leans towards disciplined investing. Stick to your plan and consider dollar cost averaging.
Right, investing a fixed amount regularly, regardless of the ups and downs.
Exactly. It helps average out your purchase price and avoids the, frankly, impossible task of perfectly timing the market bottom.
And the article does seem to stress that things are still pretty unpredictable in the short term. Like, we could easily see more dips.
Yes, definitely. That near-term uncertainty is a strong theme. Despite that relief rally after the pause announcement, the core issues, especially those trade tensions with China, are far from resolved. We're likely not out of the woods yet.
Yeah, that seems like the sensible takeaway. That pause feels more like a temporary truce than a final peace treaty.
I think that's a fair assessment based on the article. The 90-day pause bought some time, maybe some negotiation space, but it didn't fix the fundamental disagreements or the underlying economic pressures. So caution and a long-term focus seem to be the advice.
Okay, so for everyone listening, let's try to boil this down. Our deep dive into the Motley Fool's analysis suggests that, yeah, the S&P 500 is below that specific pre-tariff level around 5,670. But
it's complicated.
Very complicated. We're still looking at likely market volatility. There are real underlying economic concerns that predate the latest tariff moves, and valuations, well, they don't exactly scream bargain bin right now.
And that 90-day tariff pause, while providing some temporary relief, hasn't really changed the fundamental risk landscape, especially regarding China.
Right. So that brings us to our final thought for you, the listener, to kind of chew on. Given all this, the ongoing trade stuff, the economic signals, current valuations, the temporary nature of the tariff pause, how does this actually shape your personal investment approach?
Yeah, how does it influence your comfort level with risk right now? And maybe more importantly, what does long-term investing truly mean for you in the context of your own specific financial goals and your timeline? Something to really think about.